The Consumer Price Index, the CPI, just came out for May 2026, and it printed at 4.2%. That is the highest inflation reading in 3 years. And if you have a mortgage, a savings account, a 401k, or you've been paying to fill up your gas tank lately, this number is directly connected to your money. But here's the problem. Almost every headline you're going to see today will give you the number and stop there. Inflation hits 4.2%. Done. And then you're left wondering, okay, but what does that actually mean for me? That's what I'm going to break down today. By the end of this video, you're going to understand what's actually driving this inflation spike, why the Federal Reserve is now trapped and they cannot get out, and exactly what this means for your mortgage rate, your retirement account, and your purchasing power going forward. Let's get into it. So, let's start with why this number matters, more than the media is telling you. 4.2%. That's not just a number on a chart. That's the government's official measure of how much more expensive everyday life got over the last 12 months. Here's what that actually means in your life. If you spent $10,000 on living expenses last May, groceries, gas, utilities, rent, insurance, that same lifestyle now costs you $420 more per year for every $10,000 you spend. Most American households spend significantly more than that, so the number gets bigger. Now, here's what most people don't realize, and this is the part that almost nobody is explaining today. This isn't just about expensive groceries. It's not just about gas prices. It's about what this number forces the Federal Reserve to do. And what the Fed does affects every single financial decision in your life, whether you realize it or not. Let me explain the mechanism. The Fed has what's called a dual mandate. Their job, their literal legal obligation, is to keep unemployment low and to keep inflation around 2%. Inflation is at 4.2%. That's more than double their target. So what does the Fed do when inflation is too high? They raise interest rates, or they keep them where they are. Higher rates make borrowing more expensive. That slows spending. That reduces demand. That theoretically brings prices down. But here's the trap, and I want you to really sit with this, because this is the most important thing I'm going to say today. The Iran war isn't a demand problem. It's a supply problem. The Federal Reserve cannot pump more oil out of the ground by raising interest rates. They cannot resolve a geopolitical conflict with monetary policy. They cannot make gasoline cheaper by keeping mortgage rates high. So they're stuck. They can't cut rates because headline inflation is 4.2%, and that would look like they're surrendering to inflation. But their high rates aren't actually fixing the root cause of the problem. They're just making every single American's borrowing costs more expensive, while the real world waits for the geopolitical situation to resolve. That is the trap, and your financial life is sitting inside it right now. Quick question for you, and I'm genuinely curious. Where are you feeling this inflation the most right now? Gas? Groceries? Your mortgage payment? Drop it in the comments below. I read every single one, and it shapes what I cover next. And if this breakdown is helping you make sense of the headlines, hit subscribe. I do this every week. And next week, I'm breaking down what new Fed Chair Kevin Warsh is likely to do at the July meeting. That's going to be a pivotal moment, and you're going to want context before it happens. Okay, now let's follow the money, because this is where it gets personal. If you've been waiting for mortgage rates to drop so you can buy a home or finally refinance, today's report just extended that wait. The 30-year mortgage rate is tied to the 10-year Treasury yield, which is directly shaped by Fed policy. As long as the Fed keeps rates elevated, and they will with 4.2% CPI, mortgage rates don't move down meaningfully. We've been in this frozen housing market for going on 2 years. Sellers are locked in with their 3% pandemic-era mortgages and won't sell. Buyers can't afford the current rates. Transaction volume is near historic lows. And today's CPI reading tells you that thaw is not coming anytime soon. If you're currently in an adjustable rate mortgage, this is the moment to understand your reset timeline. Know when your rate adjusts. Know what it adjusts to. Don't get caught off guard. Here's the one semi-positive note in this story. High-yield savings accounts are still paying real rates, in the 4 to 5% range at many online banks. And if rates stay high, those rates stay elevated too. But here's the catch you need to understand. If your savings account is paying 4.5% and inflation is running at 4.2%, your purchasing power is barely staying flat. You're not building real wealth. You're on a treadmill. You're working hard just to stay in place. That's not a reason to panic, but it is a reason to think beyond just, I have money in savings, I'm fine. Now let's talk about your 401k. This is the one I want you to pay close attention to. If your 401k has a significant allocation to bond funds, treasury bonds, municipal bonds, bond ETFs, target date funds with heavy bond exposure, those are under real pressure right now. Here's the mechanism, and it's simple once you see it. When interest rates stay high or go higher, the value of existing bonds falls. Why? Because a bond that was issued at 3% is worth less to investors when new bonds are paying 5%. The market marks down the older bond. If you haven't opened your 401k recently and looked at what you actually own, not just the account balance, but the underlying holdings, now is a good time to do that. Not to panic, not to sell, just to understand your exposure. Knowledge is the tool here. This is the question everybody is really asking underneath all of this. When you have persistent inflation, meaning elevated prices that stick around for an extended period, money historically flows toward hard assets. Things with limited supply, things that can't be printed, diluted, or inflated away. Gold has been one of those historically, and gold has been performing. But there's another asset that has been increasingly capturing that inflation hedge demand from institutional investors. And I want to be clear, I'm not starting from Bitcoin and working backwards. I follow the evidence. I've been doing this for 25 years, and the logic of limited supply as an inflation hedge leads to one other place. Bitcoin has a hard cap of 21 million coins. Ever. No central bank can print more of it. No Federal Reserve meeting can change the supply schedule. When large institutional money is looking for a store of value that cannot be debased by monetary policy, that's where the evidence points. You don't have to take my word for it. Watch what the major banks are doing. Watch what sovereign wealth funds are doing. Watch where the allocation conversations are happening at the institutional level. That's your signal. Let me tell you exactly what I'm watching over the next 90 days, and what you should actually do with this information. Number 1, core CPI over the next 2 months. Today's core CPI is 2.9%. The headline is elevated at 4.2% because of energy. If the Iran conflict de-escalates, if oil supply starts recovering, that headline number could come down relatively quickly. And if it does, it gives the Fed political cover to start cutting rates. Watch the trend. Not the 1-month reading, the trend. If core stays at 2.9% or falls toward 2.5% over the next 2 months, while headline comes down with falling energy prices, that's a potential rate cut setup going into Q4. If core starts moving up, meaning inflation is spreading beyond energy into services, housing, food, that's a more serious structural problem, and the Fed will have to hold tighter for longer. Number 2, the July Fed meeting. Kevin Warsh is the new Federal Reserve Chair. He replaced Powell earlier this year. The July meeting is his first real test in front of a high inflation print. He almost certainly cannot cut rates with 4.2% CPI. But listen to his language carefully. Does he describe the energy shock as transitory, meaning temporary, the Fed will look through it? Or does he signal they're treating this as a structural problem requiring sustained tight policy? That distinction will move mortgage rates, bond markets, and equities. Pay attention to it. I'll be breaking that down the week it happens. Now, I want to be straight with you. I'm not a financial advisor, and none of this is financial advice. But here's how I'm thinking about this environment. 1. If you're in an adjustable rate mortgage, know your reset date and understand your worst case scenario if rates are still elevated when you reset. Don't get surprised. 2. Review your 401k bond allocation. You don't need to overhaul it, but understand your duration risk. Short-term bonds carry far less rate risk than long-duration bonds right now. 3. Don't make reactive decisions based on 1 month's data. The worst financial moves are the panic moves. 4.2% is uncomfortable. It is not 1970s-style runaway inflation. Stay grounded. 4. Think about inflation hedges proportionally, not as speculation. As a rational response to an environment where your purchasing power is being eroded. And here's the thing I keep coming back to. This is one data point. What matters is the story. Is 4.2% the ceiling, or is it still climbing? The Iran conflict trajectory is going to answer that question more than any Fed statement. I'm watching, and I'll bring you what I find. Here's the one thing I want you to walk away with today. The 4.2% CPI reading is not just an uncomfortable headline. It's a structural signal. The Federal Reserve's hands are tied. Mortgage rates stay elevated. Bond funds face headwinds. Your purchasing power keeps getting tested by an energy shock the Fed can't fix with interest rates. But it also tells you exactly where to look for the opportunities. Fixed supply assets, real understanding of your own balance sheet, and the patience to let the geopolitical story play out rather than making panic moves. I've linked some additional resources in the description below, including a deeper breakdown of how the Fed's rate path affects mortgage rates specifically, and what to actually look for in your 401k right now. Next week, I'm breaking down Kevin Warsh's first major speech as Fed chair, and there is one line in it that almost nobody picked up on. It has direct implications for mortgage rates through the end of 2026. I don't want you to miss that. Subscribe so you don't. I'll see you in the next one.